Every empire begins not with a transaction, but with emotion. The way we feel about money shapes every choice, every investment, every risk we take. When emotion leads, logic follows, often too late. Wealth is less about arithmetic and more about emotional discipline, one tested under pressure and temptation alike. Across trading floors, boardrooms, and kitchen tables, one emotion silently bends decisions toward regret. It whispers louder than greed, hides deeper than fear. This emotion masquerades as prudence, yet robs countless people of long-term prosperity. It isn't lack of intellect, it's the tyranny of uncertainty dressed as caution. The emotion that ruins most financial decisions is fear, fear of loss, fear of missing out, fear of being wrong. It's the invisible tax on potential, silently draining wealth before it's even earned. Fear wants safety at all costs, but safety and growth rarely share the same address. Economists track it through market volatility, but psychologists see it in eyes that flinch when facing risk. Fear triggers primitive survival instincts that sabotage modern wealth building. It persuades people to sell low, to hoard cash, to settle for comfort instead of compounding returns. When fear dictates investment decisions, data becomes decoration. Logic collapses under emotional pressure, replaced by short-term panic. Even billionaires feel it, but the wealthy learn to treat fear as a signal, not a command. They dance with risk instead of running from it. To understand fear's grip, imagine the nervous system during a downturn. The heart rate spikes, cortisol floods the bloodstream, and clarity vanishes. Every instinct screams to retreat. But financial mastery begins when one recognizes that those sensations are signals of opportunity, not threats of ruin. Throughout history, the wealthiest individuals thrived in crises because they redefined fear. Rockefeller expanded when others froze. Buffett bought when panic screamed louder than reason. Their secret wasn't superior math, but emotional neutrality under chaos, a discipline forged through repetition and reflection. In contrast, the average investor follows the emotional herd. Prices rise, optimism peaks, euphoria blinds judgment. Then reality corrects, and fear floods back in, locking losses. The cycle repeats, the pendulum of greed and fear swinging endlessly, devastating generational wealth. The psychology of wealth demands emotional literacy. To grow capital sustainably, one must decode feelings before they dictate action. Naming fear, observing it, and redirecting its energy toward preparation transforms fragility into resilience. Wealth isn't seized, it's composed calmly, decision by decision. Behavioral economists describe this as loss aversion, the human bias that makes losses feel twice as painful as equivalent gains feel pleasurable. It's why people chase small wins but avoid major opportunities. Fear magnifies downside while whispering sweet comfort in mediocrity. Modern financial systems amplify that bias. Newsfeeds pulse with crisis headlines, algorithms reward outrage, and dopamine anchors uncertainty. The modern investor isn't fighting markets, they're battling their own biology, coded for survival in jungles, not digital exchanges. Fear makes one hoard cash when inflation silently erodes it. It makes one delay investing until prices peak. It convinces families that economic chaos is unavoidable and innovation dangerous. Yet history shows that those who master fear often redefine entire economies. In the hidden language of money, courage is the rarest word. Not reckless impulse, but calm conviction amidst noise. Courage chooses long-term value over temporary relief, perspective over panic. It's slow, deliberate, and brutally unfamiliar to a mind trained by fear. Imagine your financial life as a chessboard. Each move reveals an emotional signature, patience, anxiety, greed, or fear. When fear dominates, it sacrifices queens to protect pawns, prioritizing immediacy over strategy. The disciplined player embraces calculated risk and lets logic move the king. Some believe they can think their way out of fear, but emotion doesn't yield to intellect alone. It requires exposure, taking small, structured risks until the body learns safety in uncertainty. Like financial weightlifting, repetition rewires response patterns over time. We see fear destroy wealth in subtle ways: a business owner delaying expansion, an investor missing a decade of compounding, a retiree clinging to cash that earns nothing. The damage rarely appears as loss, it hides as unrealized potential, compounding invisibly through inaction. To overcome, one must build a process stronger than mood. Automated investments, diversified portfolios, disciplined savings plans, these frameworks replace impulsive emotion with predictable systems. Fear thrives in ambiguity, but collapses in structure. Every wealthy mind separates emotion from execution. They prepare rules while calm, then obey them when storms arrive. It's not about bravery in the moment, it's about eliminating decision fatigue before fear has a chance to speak. Preparation silences panic. The modern economy rewards those who act despite emotional discomfort. Fear never disappears, it simply gets quieter each time you move through it. Wealth accumulates through measured discomfort, not reckless courage, but consistent discipline under emotional fire. Financial education rarely addresses emotional architecture, yet it's the foundation beneath all success. Charts and returns mean nothing if fear dictates timing. Teaching emotional awareness should sit beside teaching compound interest, both calculate growth, one material, one psychological. Imagine two investors identical in resources but opposite in response. One reacts emotionally, the other systemically. Over decades, their net worth diverges exponentially. Fear costs not through loss, but through missed participation, absence from the markets where wealth actually grows. Fear feeds on isolation. Conversations about money often feel taboo, trapping individuals in echo chambers of anxiety. The wealthy break that pattern, seeking mentors and communities grounded in data, not drama. Insight replaces instinct, and perspective mutates panic into power. Technology can either amplify fear or manage it. Algorithms that automate investing, balanced portfolios that rebalance automatically, and financial literacy tools all transform emotion into analytics. The trick is to use machines as emotional stabilizers, not amplifiers of speculation. Fear thrives in ignorance, it weakens under education. When you understand liquidity, diversification, and market cycles, uncertainty becomes manageable. Knowledge turns volatility from threat to opportunity, because awareness removes the mystique that fuels panic. History celebrates risk-takers, yet true wealth builders are calculated experimenters. They invite controlled exposure to uncertainty, ventures, investments, innovations, while measuring outcomes precisely. It's not gambling, it's structured evolution toward mastery, fear as a companion rather than a jailer. Financial fear masks itself as responsibility. Parents justify avoiding risk as protection. Workers cling to stagnant income for stability. But real protection lies in adaptability, skills, assets, and networks that endure beyond any single paycheck or market. The wealth mindset isn't fearless, it's skeptical of fear. It asks whether the emotion is based on fact or narrative. It replaces emotional storytelling with statistical probability, converting anxiety into informed patience. That's emotional intelligence in motion, the true unseen hand of wealth building. Observe any economic crisis. Within it, fear separates the opportunists from the overwhelmed. Some freeze, while others reframe uncertainty as a window for reallocation. The difference lies not in resources, but in interpretation, the story one tells when numbers fall against them. Those who transcend fear don't chase highs. They maintain rhythmic, emotion-proof decision-making. Like pilots in turbulence, they trust their instruments, the data, the plan, the process, knowing that emotional impulses crash portfolios faster than storms crash planes. Financial composure is contagious. Families that model calm money conversations breed generations of investors with emotional immunity. Schools that normalize market cycles reduce economic trauma. Fear is inherited belief, but belief can be reprogrammed, replaced with literacy and logic. When ambition meets fear, mediocrity wins unless awareness intervenes. Successful investors visualize fear like static noise, always present, rarely informative. They tune it out, focusing on signal, value, cash flow, fundamentals. Mastery is mental filtration, not emotional suppression. In the psychology of wealth, emotional control outweighs financial genius. Data without discipline is noise, discipline without calm is collapse. The journey to abundance lies in training the nervous system to stay aligned with rational decisions through every market storm. To build true wealth, replace emotional reaction with structured patience. Diversify across time and instruments, automate investment flows, and measure progress quarterly, not daily. Detachment becomes the ultimate financial superpower, shielding mind and money alike from fear's erosion. As the curtain closes, remember this: fear will always exist in finance, but it need not control you. Channel it, study it, profit from it. The wealthiest aren't those who avoid fear, they are those who mastered its language and rewrote it into their own fortune script. Your financial destiny depends not on markets, mentors, or algorithms, but on mastering the story you tell yourself when risk knocks. Fear may whisper limits, but awareness narrates legacy. Choose clarity over panic, and you'll find that wealth was never about money, it was about mastery of mind.